Today, we will focus on one of the most strategic documents in project finance, the Intercreditor Agreement. While the facility agreement governs the relationship between lenders and the borrower, the Intercreditor Agreement governs the relationship among creditors themselves. In multi-layered capital structures, including senior lenders, mezzanine lenders, hedge counterparties, and sometimes intragroup lenders, this agreement defines who gets paid, when, and under which conditions. Let us begin with definitions and interpretation. Precision is critical. Defined terms such as senior liabilities, subordinated liabilities, enforcement action, or insolvency event determine the allocation of power and recoveries. The core of the document is ranking and priority. This section establishes the waterfall between creditor classes. Typically, senior facility creditors rank ahead of mezzanine or subordinated creditors in respect of security and proceeds. Hedge counterparties may share the same ranking as senior lenders or have a specific position within the payment waterfall. Understanding this hierarchy is fundamental for pricing risk and estimating recovery values. Closely linked to ranking is the concept of subordination. Subordinated creditors agree that their claims are junior and that they will not receive payments until senior debt is serviced. Subordination may be structural, contractual, or both. For finance professionals, the key question is how effective this subordination is in an enforcement or insolvency scenario. Guarantee and indemnity provisions often clarify how claims between creditor classes are preserved. They ensure that payment flows and risk allocation remain consistent even if the legal structure is challenged. The effect of an insolvency event is another critical section. It determines how claims accelerate and how enforcement rights are coordinated once the project company becomes insolvent. In project finance, value preservation during distress is essential. The agreement usually restricts individual enforcement actions to avoid value destruction. Turnover of receipts and redistribution provisions are highly technical but extremely important. If a junior creditor receives money in breach of the agreed ranking, it must transfer that amount to the senior creditors. This mechanism reinforces the agreed priority and prevents leakage of value. Enforcement of transaction security defines who controls enforcement. Typically, a security agent acts on behalf of all secured creditors. Individual creditors are prevented from enforcing security independently. This collective approach ensures coordinated action and maximizes recovery. The agreement also distinguishes between non-distressed disposals and distressed disposals. In a non-distressed situation, asset sales may occur with limited creditor interference, provided that proceeds are distributed according to the agreed waterfall. In a distressed scenario, the senior creditors usually control the enforcement process, including credit bidding or appropriation of assets. Application of proceeds is one of the most scrutinized sections. It sets out the detailed payment waterfall, costs and expenses first, then senior interest and principal, hedge liabilities, mezzanine debt, and finally, subordinated claims. Small drafting nuances in this waterfall can materially impact expected recoveries. Equalization provisions ensure that lenders within the same class share recoveries on a pro rata basis. This prevents disproportionate outcomes among creditors of equal rank. The role of the security agent is central. The security agent holds the security on trust or in a similar capacity for all secured creditors. The Intercreditor Agreement defines its powers, discretion, and liability standard. From a risk perspective, the scope of the security agent authority directly affects enforcement dynamics. Changes to the parties regulate how new creditors can accede to the agreement and how existing creditors may transfer their participations. Accession mechanics are particularly relevant in syndicated transactions and secondary market transfers. Finally, governing law and enforcement determine the legal framework. Cross-border projects require careful alignment between the law governing the security documents and the Intercreditor Agreement. In conclusion, the Intercreditor Agreement is not merely an administrative document. It is the rule book for creditor behavior in both normal operations and distress. For finance professionals, its real importance emerges under downside scenarios. Always analyze who controls enforcement, how proceeds are distributed, and whether subordination is robust. That is where credit risk ultimately crystallizes. If you found this summary useful, don't forget to like, subscribe, share this video with your colleagues and friends, and check the description below the video for useful information.